Sometimes I forget. All right. I see that you're recording.
Yep, that's my house back there that I got listed
Oh,
on not owner finance, 2.75% interest rate,
mm-hmm.
assumable FHA.
Oh, it's assumable.
Mm-hmm.
Okay, that ought to be a winner.
You would think, but
Yeah.
it's been listed now about 60 days.
Oh, you got to be kidding me. Where is it?
It's in Katy, Texas.
Oh, well, I heard Texas has a glut of houses for sale that are on the market for some reason.
Yeah, I don't know what's up with that.
Yeah, I don't know what's up with that either. But that was in the news.
Hmm.
But 2%, somebody should have, jumped on that.
You would think.
Yeah. Uh,
Well,
and
it's 6:01. I don't want to, delay you.
no, what are the
Other
tell me about that house. What are the um what's the asking price?
440,
440, and
five
that
bedrooms.
that's based on the comps in the area.
It's a little high based on the comps, but yeah, I was just sending her information on to let her know what other homes have sold for in the
Right.
area. And the problem is there's new construction that's a few miles away that's selling
That's
for less
always going to be a
than that.
problem. Yes. And nobody's going to buy if I can get me a new construction for less than this. So are they upside down in the house?
No,
Well, then they need to take less.
yeah. And
Yeah,
they,
they're
they
not going
want
to
to
get it.
they want to get a new house. They're getting a new house built.
Uh-huh.
So,
Yeah. So if they want to save money somewhere else, have them talk to me and I can save them money and interest on their current situation. And I might be able to show you some things here.
okay.
You might be able to tell them to, so that they'll accept a little bit less to get the project moving. And they may not need to use all of their proceeds from this house as a down payment on the next.
Interesting.
Yes, you don't want to ever put a large down payment on a house ever. That's one of the things I wanted to talk about today.
Okay.
Yeah. Yes, 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 yes. So yeah, when you were inviting people to see me, you probably want to say, listen, you need to watch some of these videos because this is going to be something that's going to be very helpful to help you to sell more houses that no one else is teaching. And I'm glad you're recording this so that you can show folks something. So let's start with this. Let's start with an example that most people would think would go the other way. And then we'll get into some of the basics,
Okay.
okay, as to why that actually works. The other thing we're going to learn is this is just scratching the surface. And by you watching this video or watching the replay, you are not learning the system. You're just learning some of the basics. You really do need to have additional instruction before you try to put these things into practice because you can learn just enough to get you in trouble.
Mm-hmm.
Okay? So here's an example. Let me put this on the screen and then we'll go in, but it works much better if I'm gonna turn my recording on as well. It'll work much better if we interact.
Okay.
Okay? All right. So let me put this on the screen. And then we'll go from there. There we go. So the amortization schedule that I'm using is not mine. This is from Brett Whistle, Bret. His last name is Wissel. The reason why I use this amortization calculator is because it gives us two columns that most amortization schedules do not give you. Okay. So we're going to put in, let's use that 440 number you just gave me. Okay? 440. And let's put in at 7%. But probably interest rates dropped a little bit lower than 7%, but not much. So we'll start there. Now, here's the first thing we're going to learn. If you can afford the payment at the higher interest rate, jump on it with both feet. It'll work much better for you than trying to wait for 5% or trying to buy your way down to 5%. I would never do it. If I can afford this payment, give me the 7 as opposed to 5. I can pay this off faster and cheaper. Okay, so that's the second thing we're going to get to. But the first thing we're going to get to is, what if I had an extra $100,000 to put on this loan? All right. So if I had an extra $100,000, would I be better off having the $440,000 loan for 30 years or the $330,000 loan for 30 years? What do you think?
I think I know the answer.
Well, I mean, I'm just got to have a conversation here.
I'm gonna say,
What
go
would
ahead.
most people
Go,
say?
most people would probably go with 330,
But why?
three forty,
Why would they go with 340? Why would you think?
because they are saying I'm having a lower principal. But
Mm-hmm.
if I understand this concept, it's better to take that extra money and put it toward the principal periodically to
Mm-hmm.
pay down the interest rate, because you start off with a lot of interest at the beginning.
Right. And so now we're going to find out, we have to find out that the way that we have not been taught how loans work is financial violence. Okay. So you're in a business that is dependent on bank financing to do well in your industry. Correct? Not correct.
Correct.
Okay. Then when you were taking your test to become a realtor or even a broker, why aren't you taught how a loan or a mortgage actually works?
I'm also a lender.
And a lender. Okay.
So
We'll throw the lender in there
they
too.
still didn't teach us that.
And they still didn't teach you. Okay.
Uh,
You're a lender and an agent and possibly a broker, and still we know nothing about how this thing actually works.
I just wanted to follow the money.
That is something else. Now, what we're going to do for you is help you to make even more money by educating your clients above other people's clients. All right. So here's an example of what I'm talking about. So I've got this here. We're going to do this and duplicate this tab. Okay. There we go. So we're going to put in 340. And then we're going to make some notes. Okay. You're going to make some notes. And then we're going to show the differences. So the first difference, the principal and interest payment is 29.2733 on the 440 loan. The principal and interest payment here is 2,262. So already it looks like putting $100,000 down is going to get me a better payment. Okay. We're going to take a look at total interest cost on this for 30 years. $613,000
Jesus.
just in interest alone,
Just
which
in
just to, so the total real price on this home is $1,053,000. 9 out of 10 people will never pay off a mortgage ever.
Hmm.
So if you think about it, of all the people you know or have ever known, how many of them actually have paid off a loan? It'll be less than 10% of the people you know. Why are we in a system where 90% of us are set up to fail?
Hmm.
Okay. So let's see what we can do to turn those numbers around so 90% of us can actually do the very thing that we set out to do. 90% of us can win. All right. So here's what we're saying. So that's 613,000, but on the 340,000, look at there, 447, 474 rather. 474 versus 613. Well, let me do this. I'm going to put a calculator on the screen. Are you seeing the calculator?
Yes.
Okay, good. All right. So I've got, uh-oh, it disappeared. So we're going to do a little math here. Okay. So we have 613,838 and 80 cents. Now this is we're going to be here for some time. We'll quit when you say you have to go. How's that?
Oh, I
You all
was
right?
I was banking you for an hour.
That's all right. Whatever you want to do.
Okay.
Whatever you want to do. We'll quit when you want to go. All right? Because there's a lot of information. If you want to come back and get a little bit more information, we'll do that as well. But there is a lot. All right. 613,838. So we're going to subtract the 474 minus 474. You're seeing this, right?
Yes.
330 and 80 cents equals 139,508. So by putting $100,000 down, the total interest cost drops by $139,000. That's how this is sold. Okay. But if I take the $440,000 loan, I still have my $100,000 in the bank, don't I?
Yep.
Okay. Let's go over the basics here. So if I make this payment here, where $360 of my payment goes to principal, 2566.67 goes to interest, that's quite a bit of money, isn't it?
It's quite a bit of money.
Okay. But if I prepay the 262.77 on line two, I get to subtract that from the 400. I get to subtract that. I get to subtract the 360 from the 440. I get to subtract the 362.77 from the 440 in the same month. Does that make sense?
Uh-huh.
So if I start out in January, I make my payment, but let's give them a little bit extra with my payment. Let's give them exactly $362.77. That brings me down to line two on my amortization schedule. Make sense?
Uh-huh.
So my next mortgage payment for February will actually be on line three, wouldn't it? Okay. So what just happened? For $362.77, I got rid of one whole line on my amortization schedule. What happened to this 2564.56 that the bank was looking for?
They don't get it.
They never get it. You just reduce that big amount of interest that they were supposed to get by $2,564.56 by taking $362.77 maybe out of a bank account that's making 1/10 of 1%. Hardly no interest at all. We put it over here and we save $2,500 in interest we never have to pay. Plus, we turn 360 monthly payments into 359 monthly payments, just like that. Okay. So if I were to take three of these, 362, 364, 367, about $1,000, a little over 1,000, and put that with my first payment, I knock off three of these interest payments for an extra 1,000. I knock off $7,500 worth of interest I never have to pay.
Now that could be done at any time or just at the beginning of the mortgage.
You can knock off interest at any time, but you can't save this much interest a year later because the interest payments are actually smaller.
Right.
Okay. And the principal payments are larger. Okay. So the longer you wait, the less interest you can save. Make
Okay.
sense?
Mm-hmm.
Okay. So now let's take a look at, so we can take a look at cumulative principal and cumulative interest. Does it make sense that after 1 year, we would pay this loan down by $4,469.54. These are the two columns you will not get in a regular amortization schedule. Okay. You will, so we're going to add up all the principal, that's all of these principal payments. It comes to 4469.54. This column adds up all the interest. All of these payments. $30,658.42. That's what it costs to pay this loan down by $4,400. Isn't that ridiculous?
It is.
And most people never pay attention to that, even though they can well afford it. They can well afford the payment. So here's my question to you. If I know I'm going to pay this over a year's time, do I have to give it to the bank in 12 monthly installments?
No,
If I have it, can I give it to them all at once?
if you have it.
If I have it, then they would have to subtract it from what I owe, wouldn't they?
Mm-hmm.
So we're going to put in 440,000 and subtract 4469.54 equals 435,530.56. I must have put in the wrong number. I must, because I'm off by a dime. Okay. Okay. 435,530 right here. We would be right here.
Okay.
Okay. So if I subtract this, I can subtract it in 12 monthly payments or I can subtract it in one. But if I give it to them all at once on line one, I'm paid down to right here in 1 month. What happens to all these interest payments?
They go away.
They go away. So if I know, if I have the money, if I know I could give it to the bank and be paid to right here in 1 month, does it make sense to pay the bank $30,000 in interest to do it their way?
Mm-mm.
No. If I give it to them all at once, you know how much interest it costs me? 25, 66, 67 interest on the first line. That's a big difference between $2,500 or $30,000. It is that simple.
Hmm.
Do you see why we don't know how this works and why you're not taught how it works?
Yeah, the banks don't want you to know that.
Right. Because the banks do not make their money on interest. The banks make their money when they sell that mortgage to an investor.
Hmm.
Because you probably witnessed it. Your clients have probably called you and say, you know what, that mortgage you gave me, I just got a letter. Somebody else owns the mortgage.
Yeah.
Okay. So the one thing that people who invest in mortgages, the number one thing that they're most afraid of? Prepayment, paying ahead of time. When you, as an investor, when I buy this mortgage as an investor, I get this whole payment, 29, 27, 33. I get the whole thing. But the homeowner only gets to reduce what they owe by $360, but I get the whole thing as an investor.
Those are
And be
those are note investors, right?
right. Okay. So as they do that, the payment that I receive is discounted by $2,566.67, which means the person that signed the note has to make so many more payments to pay off the 440,000. So if I am the bank and I'm dependent on investors buying these mortgages, don't I want this whole idea to be as attractive to investors as possible?
Yeah.
That's why you all don't know how easy it is to save 30 grand. Does that make sense?
Mm-hmm.
Okay. That's the number one thing that they're afraid of.
So what about the way I was taught years ago when I had a mortgage was to make an extra principal payment either every month or every year so that it equaled up to a whole payment to reduce the interest and the amount of years. Because I
Okay.
think we had gotten our 30-year down to maybe 20, but then we sold it. So,
Well, a biweekly payment program,
uh-huh.
okay, will save you between 4.9 and 7 years on a mortgage, no more than 7 years. Because by paying biweekly, you end up paying 13 payments a year.
Right. One extra
Okay.
one.
One extra payment a year. Okay. But what if you have more money available? Okay.
Yeah.
Instead of doing that and saving, cutting off in seven, you can use cutting off 7 years. You can use your current budget, live well, save additional money, and pay off this mortgage in 7 years and save 23. When you understand this part. Okay. The reason why we don't know any difference is because the way we've been taught to think about it, anything I can do to save money on my mortgage or pay it off faster, anything that I can do is as good as almost any other thing that I can do. They're all about the same, which is not true. There's a big difference when I know how much interest I'm actually saving when I do something.
Mm-hmm.
Okay. So if I can pay this much and save 30 grand, which makes sense now, what if I have my $100,000 that I could put down and have a $340,000 loan, or I can have a $440,000 loan with $100,000 still in the bank? If I wanted to, what could I do with my $100,000 now?
Put it toward the principal?
Exactly. And let's see, because we can use cumulative principal, we can actually see what it's going to do for us. So all we have to do is scroll down to where it says 100,000, right?
Thank you.
Look at here. Yeah. I just scrolled. That's 166 payments.
And what year is that?
Oh, let's do that. 166 divided by 12. That's almost 14 years. 168 payments would be the 14th year. You can knock off almost 14 years in 1 month by putting that $100,000 down after you close.
Hmm.
Now, do I still have right here? Do I still have a $340,000 loan? Look here. It's still 340,000, isn't it?
Yeah.
Yeah. So I can have it at the beginning. I can have a whole 30-year mortgage starting out at payment number one on 340,000, or I can have one starting out on line 167 and still have a $340,000 loan.
Yeah, I need to run into these people that's got an extra $100,000 though.
Well, not, I'm just using that as an example.
Yeah.
But you know people who have put more down than they've needed to put down. How long you been in the business?
7 years.
7 years. So in 7 years, you've probably run into somebody who put down more. If they had an FHA, they put down more than the 3%. If they had a conventional, they put down more than the 10%.
I've only been doing loans for maybe a year though, so I haven't, got into people's finances like that. Like
Mhm.
I'm starting to now. So
Okay. So how long have you been into selling real estate?
7 years.
7 years. So you've never run into anybody who wanted to put down more than the minimum?
Well, I don't know that because I would send them to a loan officer and they would discuss the finances. So
You never see the HUD.
I didn't know what they had in their bank account.
Oh,
Yeah.
okay.
So, but
All right.
I'm starting to get into all of that now. So
Isn't your commission based on how much they actually end up borrowing?
no, it's
No,
how
what's your
how much the house sells for.
oh that okay. How much the house sells for?
Yeah.
Okay. Well, if I put down $100,000 down payment on this loan, doesn't the house sell for 340,000 instead of 440,000?
No, because the house is still 440.
Really?
Yeah.
And you make your commission based on that?
Yes.
Okay. I guess you wouldn't pay attention to that. See, I'm not a real estate agent.
Yeah.
Yeah. Okay. But anyway, here's the point. So that makes if you were to explain that to one of your clients, that would help them out greatly, wouldn't it?
It would.
Okay. So now let's get into some other things where we are trying to understand what is really going on behind the scenes here. Okay. So I want to help a client who's saying, I want to, I want to purchase or buy down the rate. Have you seen that?
Yes.
Okay. So the money they spend to buy down the rate, would it be better for them to take their 12, their 17, their $15,000 and put it on principal instead of buying down the rate if they can afford the payment?
Yes.
Okay. Now here's the other thing. Let me show you something here. I've got 440,000 at 7%. What if I could buy the rate down to 5%? I want to show you the difference here. The payment is just a little bit less, 2362 versus 2927. Okay, a little over 300 bucks. All right. So now I've got a 5% loan, and I want you to see something. At my 7% loan, look at my principal payment: 360, 362, 364. Okay.
Mm-hmm.
Remember when I said if I could prepay the 362, I can get rid of one loan?
Mhm.
I'm sorry, one loan payment. So remember this. Control the principal payment and you control the loan, not the interest rate. Control the principal payment and you control the loan. And interest payments I can skip, don't matter. Because if I lower the interest rate, look at my principal payment now. This is the 5% loan. Look at my principal payment now. To get rid of one whole payment, how much do I have to come up with now?
The other one was four something, right?
The other one was $362.77. So is it easier to come up with $362 or 530?
Uh-huh.
Because I'm going to get that money from money I've saved. So do I want to get a bigger bang for my buck? Remember when I said $4,469.54 takes off an entire year off this loan, doesn't it? And saves me a ton of interest. But 4,469 on a 5% loan, 4,469. Between 8 and 9 months, that's all it does for me.
Right.
Lower the interest rate, you make it harder to pay the loan off cheaper and faster.
Hmm.
Now, who knows that as a fact?
That's hard. Let me wrap my head around that.
Okay.
The lower the interest rate makes it
Harder and more expensive to pay the loan off faster.
okay.
Because I want every dollar that I can put towards this to work harder for me. Correct? All right. Can I show you something else?
Sure.
Now, a few years ago, 70s, you could get maybe a $50,000 to $70,000 home, but the interest rate was between 12 and 18%. Right?
Yep.
But ironically, some of our grandparents actually paid their mortgages off. How were they able to do that then and we can't do it now? And
Yeah.
they
How
had
do you do
they
that?
had 18%, they had 18% rates. You want to see that, don't you?
Uh-huh.
Now, when I show it to you, I want you to explain to me why they were able to do it, okay?
Okay.
Okay, this is your first pop quiz.
Uh-oh.
Okay? So we're going to put in 70,000, okay?
Uh-huh.
At 18% for 30 years. Okay, that's the payment, $1,054.96. Okay? Out of that payment, how much goes to principal and how much goes to interest?
Oh, $5. Let's see. $4.96 goes to principal the first month. 1,050 goes to interest.
Why was grandpa and grandma, how are they able to pay off their mortgages so fast?
They evidently paid a lot more of interest.
Take a look at the principal payment. Now explain it to me.
No. Sorry, my granddoggy is excited out here.
Well, he should be because he's probably listening to this. How
So
much do I have to prepay to get rid of line two?
$5.03.
And how much interest does it save me?
Does it save you?
Yeah, I don't
One
have to. I
49.
don't, exactly. But I don't have to come up with $5, don't I?
Right.
Oh, it's easier to come up with $5 or $400.
So they just paid more than principal.
Exactly. But a smaller amount does more work for them. How much principal do they pay for the entire year?
$64.
If they could come up with an extra $64, they can eliminate 1 year off this loan.
Huh.
You look confused.
No, I'm just thinking about back in the day when you could get a mortgage for $70,000.
Yes. Yeah. But back in the day, 70,000 is like 300 or 400,000 now.
Yeah.
Yeah. So, but here's the thing, the interest rate, they could take advantage of a higher interest rate and they didn't even know how it worked. An extra $10 takes 2 months off and saves $2,000 in interest.
Mm-hmm.
They had no idea. $142 knocks off 2 years off this loan and saves 25 grand in interest.
So what is the total if they were to pay it like that? They were to have paid it like that for 30 years.
I don't know because that's getting more.
But
You mean what was the total amount of interest if they didn't know this?
no. You could scroll down, right? Oh,
Yeah,
here.
the total amount of interest if they paid every payment would be $309,000,
$309,000, right? Okay.
which means the total interest paid as a percentage of principal would be 442%.
Ooh-wee.
So the higher these numbers, the easier it is to pay this loan off.
I got to figure out how to explain this to my mortgage clients.
Well, there's a couple of ways that we do that. If they're interested in knowing more, you let us explain it to them. And then every time we explain it to them, you make sure that you're in the class and you pick up more and more and more.
Okay.
Okay. And then if they become one of our clients, they'll be able to pay off that mortgage, not just their mortgage, but their student loans and their credit cards, everything, car loans in about 7 years using their same budget. Because you don't need more money to get out of debt. What you need is to pay less interest. So if I'm tracking my income and my expenditures, if I track it, I know how much money I have left over after all the bills are paid, correct?
Mm-hmm.
Now we know I don't need a lot of money to save a ton of interest. So if I have some money left over, what if I had a program that says, take that money and put it in a savings account? And when it reaches a certain point for you, the program will tell you, take some of that money out of the savings account and apply it to the principal of your loan, and we will calculate how much interest you're saving per dollar. You want every dollar to save the maximum amount of interest per dollar. There's a point at which putting too much on can actually hurt you.
Hmm.
Okay. Let's go back to my $400,000 loan. Do you have a calculator handy?
On my phone.
Good. Let's use it. Okay. So if I had, if I had, if money was no problem, I got plenty of money in the bank. Okay. And I only had two choices because you could prepay any amount you want. You can prepay $1, you could prepay 10 cents, you could prepay $100. It doesn't really matter. You're prepaying something. Okay. And you want to calculate how much interest you're saving. So, but I'm only going to give you two choices. I got plenty of money in the bank. Which one makes more sense? Prepay line 12 or prepay line 24? 9,262 Save 60,000 and knock off 2 years, or 4,469.54, save 30,000, knock off 12 months.
Obviously the 9,000.
Now, obviously, the 9,000. So, what we're going to figure out is what banks know, what we don't know. Every dollar saves a certain amount of interest per dollar. So, put in your calculator $30,658.42, and we're going to divide it by the prepayment of 4469.54. I'm picking these two numbers because they're just easy to see.
6.85.
6.85. Okay. So that means for every dollar, you're saving about $6.85. What's the third number after the decimal?
9.
Then it's 6.886. Yep. So that's how this works. The bank rounds it up to the next. Anything 5 and over, they round it up to the next penny. Okay. All right. So $6 and what?
8.6.
86. So if you knew that every dollar you put on here would save you $6.86, wouldn't that be valuable to you?
Yeah.
So if you gave me $1 and I gave you back $6.86, how many times would you do that?
Oh, all the time.
The bank has to do the same thing. And we are not aware of the fact that if I give them an extra dollar, it makes it impossible for them to charge me $6.86. So I want every dollar to work as hard as it can. Let's do the same thing for line 24. I got 60,993.71, and we're going to divide it by 9,262.21.
Wait, that must not be right. I got 658.
Oh, really? So you're saving less per dollar?
It's more.
Was before it was 686.
658.522.
Okay.
That's more.
Oh, 6.5. Oh no, do it again.
I did
660.
something wrong.
Yeah,
So
yeah,
99,
you did. You did.
71.
60,993.71.
But that's a comma, not a period. Okay. 3.71 divided by 926.2.21
Right.
equals 6.58.
6.58. So if you could save $6.86 per dollar, do you want to save $6.58 per dollar?
I'd rather save 680.
Exactly. So there's a point at which more is too much. When do we reach that point where the amount of money that you have to work with, you're putting too much on the loan? Don't you need somebody to figure all that out for you way ahead of time and say, this is the right amount that's going to save you the most in interest per dollar at this time? That's what our program does. So it doesn't pick any old number. It picks the optimized number. You want your dollar optimized to do the most work it can for you. And we're not taught that. The way that we're taught to make a dollar optimized is to look at the sale paper on the way to the store,
Hmm.
to clip coupons,
Hmm.
okay, to get the BOGOs. I love going to the store where they have 2 for 1. I can get one box of cereal, buy one box of cereal and get two. I love that.
Yeah.
Okay. Kroger, 10 for 10. We jump on that, don't we?
Yep.
Now we can know how our dollar, we can pay off these loans and save 75% of that interest without breaking a sweat. That's what we do. We find the least amount to put on the loan, not the most. The least amount that's going to save us more per dollar so that we can get ready to do it again later. So once we put money on the debt, then the program says, oh, let's save up some more money. Let's live our lives, save up some more money. It could take us 2, 3, 4 months, but as soon as we hit that right amount for us, the program's going to tell us, put that amount on the debt.
Hmm.
And it's not going to hurt. Why? Because it's money that was left over after paying all the bills and having some fun along the way. So we're not telling people, oh, you need to put X amount of dollars on this mortgage every single month. And then they feel like they failed as soon as the hot water heater blows up or something goes wrong, and they can't do it that month. This is why those systems fall apart. But if you could tell a person, oh, whether it's $5 this month or $500 left over this month, that goes into the savings account to wait to put on debt as soon as it makes sense.
Hmm. Do you
And
ever take money from like a retirement account to put towards saving?
don't need to.
Okay.
Don't need to be because so I need so little money from my income. I can let my retirement account do what it needs to do. Now, if I have a retirement account that's underperforming, I may want to do something else with that money. Okay. And here's why. We're going to show you how to figure ROI. You ready?
Mm-hmm.
So you take what you invest, you take what you earn by investing, okay? And then you take what you earn and divide it by what you invested and then multiply that answer by 100.
Wait a
So,
minute.
okay, what I earn from investing, I'm going to divide it by what I invested to get the earnings. And then I'm going to multiply the answer by 100. That
Okay.
tells me my ROI, my return on investment. Now, do you understand a penny saved is a penny earned? Okay. So if I prepay $362.77 here that I got out of my bank, how long would it take me? Do you think I would need to keep this $362 in my bank to make me $2,500?
Oh. How many years?
Yes, there you go. Okay. But if I prepay it, that's interest I don't have to pay right now. Make sense?
Uh-huh.
So that's as good as earning that money. That's money I don't have to pay to get to the same spot in my mortgage. Okay. So if let's take that number, the 25, 64, 56, put that in your calculator. 25, 64, 56.
Hold on.
Okay.
256466.
0.56.
Oh, 56.
Mhm. And we're going to divide it by 362.77.
7072.
And now multiply it by 100.
$707.21.
That's a 700% return on your money. Where else are you going to get that kind of return on money?
Hmm.
By investing $362.77 in my mortgage, I get to save $2,500 I never have to pay the bank. In other words, it would cost me By doing what the bank told me, it would cost me over $5,000 in the first 2 months to pay my mortgage down to here. No doubt about it. It would cost me over $5,000 in interest, correct?
Right.
To pay it down to here, doing it their way would cost me $30,000 in interest.
Wow.
So I don't want to pay them that. So where can I find me some money to put on my mortgage so I don't have to pay them that?
Right.
Let's do it with these two numbers. 30,000, 658.42. Let's divide it by the 4469.54. And then multiply that answer by 100.
$685.94.
There you go. 685% return on your money. Not 5% return, not 20% return, 680% return. This is what we're not being taught. This is what the investors are making off your mortgage. And
Wow.
you just turned it around. This is why they protect that with everything they have. Let me show you. So what they're investing in is called mortgage-backed securities. Okay. So we go mortgage. Oh, let me get, I got my caps lock on. Okay. Mortgage-backed securities. Okay. Managing prepayment risk. I want to show you something. I'm going to do this. So return. Okay. Prepayment risk on mortgage-backed securities. I want you to see, I'm not going to read the articles. I just want you to see how many articles there are. Oh, here's another one. Oh, here's another one. Here's another one. Now, these that they're different colors are articles that I've actually read. Okay.
Right.
But here's another one. Mitigating risk of prepayments. Here's another one. Why consider mortgage-backed securities? The risk of mortgage-backed securities. And it just keeps on going, page after page after page. Page 2, making the move on mortgage-backed securities, mortgage-backed mitigating prepayment risk. That is the number one fear. Mitigating prepayment of these loans, they fear this more than non-payment.
Explain that.
Okay. A mortgage-backed security is when they take all the mortgages, package them up, and sell them as securities.
Okay.
And then the investors buy those securities. Okay. But they do a ton of math to figure out, they project how many of those mortgages they bought will be prepaid over the time and money they would lose. There's some very sophisticated math going on here. And this is why you don't know how much interest you could save by prepaying, because these folks don't want you to know. The whole system is built on people buying these mortgages so that the banks and mortgage companies can replenish their supply and lend some more. They don't have enough money to lend to all the people that they lend to. If people didn't purchase these mortgages, this is the main reason why in the US you can get a um, um, a fixed rate loan. In most other modern countries, most of their loans are variable rate. In fact, in Canada, you have to renew your loan every 5 years because of that. Because their system isn't based on our system.
Interesting.
Exactly. So you can thank Fannie Mae and Freddie Mac for lending out cheap money to kind of back up that system so that we can get fixed rate loans. Otherwise, we would be with the rest of the country. Most of our loans would be variable rate.
Hmm.
Here's one thing that the other thing that investors don't like is when the rates change. If I buy a loan and the interest rate is 5 and the interest rates go to 7, I feel like I'm losing money because now I'm stuck with this 5% loan. But at the time, the 5% was great.
Uh-huh.
But now interest rates went to 7. Doggone it. I missed the boat. So they try to buy up the ones that they can get at 7% now and make more money. But they count that as a loss, even though at the time it was making money. They're afraid of those two things. Interest rate changes, but they're more afraid of you prepaying the loan. That's why you're not, as a real estate investor, I'm sorry, a real estate agent, you're not taught. As a banker, you're not taught. As a MLO, you're not taught. Um, Nobody that deals with money actually learns how all of this works. Only the bankers and those who buy the securities. They know exactly how it works.
Hmm.
But we don't. So that's 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 kind of the basics. And if you want to study that and watch some more of my videos, go right ahead.
I
But
will.
if you think it's valuable to listen, you encourage some of your other friends to come on board, then what you could do is have you signed up to become an affiliate
Affiliate to what?
to Pill Method?
No.
Okay. You can make up to $3,000 a month working with me.
Tell me more.
Okay. So by going to ice10k.com and then scroll and click on affiliate. It takes about 15 seconds to fill out. You put your name, your phone number, your email, and how you want to get paid. Okay. So you find somebody who is real, who wants to get a mortgage to buy a house. They're just not wanting to pay for 30 years and all that interest. Have them watch a few of my videos online, call them in a couple of days and ask them if they want more information. If they want more information, then you go back to the same ice10k.com, scroll down underneath my picture. This is my picture here, where it says refer a friend. Click on that and input your client's information, their name, their phone number, their email, their zip code, so we'll know when to call them, and who referred them. Your name and phone number goes in here.
Okay.
Give us a little bit more information. They're expecting you to call during this time. These are the best times to call, blah, 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 blah. My team gives them a call. And when they become a client, you make $300. You send us a second one in the same month. That one is worth 400. The third one is worth 5. The fourth one is worth 6. The fifth one is worth $1,200. And it resets the next month.
Okay.
Okay. And all you do is they watch a few videos, they want more information, you send that to us, we do the work.
You'll send me the videos like to that they would watch.
We're just gonna I'll just send you a link.
Okay.
And it takes them to my YouTube channel. Uh-oh, clicked on the wrong thing. I clicked on YouTube TV. The YouTube channel, and then the link that you would get would take them straight to the live videos here. And today uh we did a study on the zero down payment mortgage. You probably want to see that. This is
Okay.
powerful stuff. No, there are plenty of lenders out there willing to lend with no down payment. Did you know that?
No.
Yeah, a ton of them. So I interview the guy that does that, that has
Oh,
a whole list, and you can work with him.
no, I've seen 1%, but I've not seen zero other than USDA and VA.
No, that's not, this is not a zero, this is not a 0% mortgage. It's 0% down payment.
Right. VA and USDA is zero down.
Right. Yeah.
Those are the only ones that I know of.
Yes. But no, this guy he can get anybody a zero down payment mortgage if the conditions are right.
Oh, okay. Yeah, I need
Th-
to watch that so I can
Yeah.
help my help my people. But
Yes.
when we first got on here, you had mentioned how my client that has the 2.75% assumable, how they could be helped by your program.
Yes. They would want, if if they're looking to get into, they're building a house right now,
Yes.
they're looking for enough money to put a large down payment on the loan. Now they don't need a large down payment
They're looking to put a down payment
on the next house.
on the next house.
Right. And now they can afford, now once they understand that you don't need a lot of money to take advantage of where the interest rates are now, they don't need a big down payment. They can take a smaller amount and use it as a prepayment to get deeper into the loan faster. So they can sell the house they have now for less to make it more attractive.
Gotcha. Gotcha.
And then they can take what they thought was a loss. And if they're, do you know how much their next house is?
Not off the tip of my,
Okay. Well,
let's say 500,000 though.
let's say 500,000. Okay. Let's say 500,000. Okay. Let's say 6.9%. Okay.
Huh?
They got 500,000. Do I have, yep, 500,000. Okay. Let's just take a look at what would happen. We're going to go slow. A $5,000 down payment saves $34,000 in interest and takes off 1 year. I mean, 5,000 prepayment, 10,000 prepayment, 68,000, 16,000, 101, 23,000. And I know they're going to get more than that. 23,000 does this, takes off 4 years, but they don't know that.
Well, they're gonna know it. I'm gonna share this video with them.
$29,000 does this and saves 167,000. That's 5 years off the loan if they use it as a prepayment instead of a down payment. So they can literally put their house on the market for what it would sell for, and then take that money and then make a killing on their new house. And we would put them in our program so we could show them exactly how to pay and when to pay so they can save a bigger bang for their buck.
Okay.
Okay. And we'll help them to find a point where they may not need to put all of their money as a prepayment. They can use the optimum amount to prepay and take any of the rest and put it in some sort of investment, like an annuity or a whole life insurance policy.
Okay.
Okay. We'll be glad to talk to them about how to use their money to their benefit instead of thinking of it the old way.
Yeah.
They need better education on what to do with that money.
We all do. I'm in my 60s and still learning about this stuff. It's just mind-boggling.
Yep. Just watch this over and over. Start watching the videos on
Uh,
and if you like if they like the shorter videos, I have there's nothing longer than 10 minutes on Instagram. The other shows are hour and a half to 2 hours
Okay.
on YouTube. So it all depends on what they're, you know what they say, the mind can only absorb what the behind can stand.
Let's see, mine is coming up on that hour though.
Yeah, we're done.
Oh, we got 6 minutes over. It went faster than I thought.
Listen, I tell you, it keeps going. People get into this and then they'll start thinking, I was going to be boring. But once we get going, there's so much good information, the time just goes.
Yeah.
And my alarm went off anyway to remind us that we need, to give you a break. But listen, I appreciate you.
I appreciate you.
Okay. And and this class that you just received
Uh-huh.
is a $500 class. You
What?
just you just got it for free.
God is good.
Listen, this would save you so much more money. For $500, you actually get two more classes. But you see what I mean. Um, the amount of money that can be earned by helping your clients save money and make money puts you head and shoulders above all the other realtors.
Okay.
Okay?
I
So,
appreciate it. I am going to share this with my other realtor friends as well as my clients.
and tell
And
them what they missed.
so they're going to see it and have all your information and be able to, get into your program. Hopefully this will
Mhm.
interest them because everybody wants to save money. We just don't know exactly how to do it. So,
Right. So what we're eventually going to do is help your clients go to ice10k.com. Okay. And then they will scroll down. This is ET, the hip hop preacher, Eric Thomas. I don't know if you've seen any of his videos online. But anyway, they would scroll down to where it says get a savings and earnings report. They
okay.
would click on that and it's free. Get a free savings and earnings report. You can know by filling this out, you can know the month, day, and year you could be debt free and how much interest you could save. And each client gets this. They fill out step one, that lets them into step two, where they put in their financial data, and our staff will get that information, confirm it with your clients, and once they understand how all of that works, then they may choose, oh, I can pay off my mortgage, my student loans, my credit cards. We could do that in about 9 years by following this program. They're in.
Awesome. Awesome.
And they'll know it ahead of time. And we guarantee their results in writing.
Oh, okay.
And if you check out Better Business Bureau, A+ rating with no complaints in 19 years.
Oh, nice. That's how long you've been doing this.
Yes.
Okay.
All right. Well, listen, it's been a pleasure. Thank you for reaching out to me.
Thank you. And we'll be in touch. Hopefully I'll continue some business.
Listen, let's work together. Let's everybody benefit. People need to understand this, and because you are sharing it with them, there's no reason why you shouldn't profit more as well by giving them better information.
That's the plan.
That's the plan.
That's the
All
plan.
right. You take it easy. Have a good evening.
Thank you. You do the same.
Uh-huh. Bye-bye.
Bye-bye.